I don't want to linger too long on your introduction because I think your words are going to speak louder than anything I can say, Sean. So please, come to the stage.
Thank you very much for everyone here joining me, and thank you for PCNZ for inviting me to speak here today. Lucky everyone in the audience, you get back-to-back economists in this session, so hey-ho. I'm going to present a slightly different view to what Cameron has presented. I'm going to focus a little bit more on commercial property markets via some of the work that RICS does with PCNZ. I will start off by giving a very brief macro outlook for the global economy. I really don't think I need to go into too much detail there. I think Cameron covered that basis pretty well. Then I'll jump into sort of where we see New Zealand markets relative to the context of other global markets. And then I'll sort of finish off by looking at one of the key risks that I see on the horizon sitting in Asia Pacific specifically. Okay, again, to start off, I think Cameron hit the nail on the head. You know, peak growth is behind us, but that doesn't mean that growth is going to disappear overnight. Indeed, it really looks robust through 2020 and 2021 globally. You do have rising rates internationally. In the US, we've already seen interest rates move higher. European Union is expected to start to begin tapering via the ECB. And in Japan, there has been some talk of shadow rate increases as well. As Cameron alluded to, you know, this has normally been fairly bad news for emerging markets. I'm slightly more sanguine on the risk, partially because I sit in Asia Pacific. And a lot of these economies that, especially in the Asian financial crisis, like Malaysia, Thailand, and Indonesia, that were hit quite hard, have done a much better job of managing their external liabilities. That being said, I mean, I think Cameron pulled up Turkey. Turkey remains a key risk, as does Ukraine and some of the South American economies that haven't done quite as well in managing some of these liabilities. And China, I don't really like to group in China with other emerging economies. I think it sort of stands on its own. We are seeing risks rise in China. The next few years will be, we will see the sort of peak refinancing risk for Chinese corporates. But I'll get into that a little bit more later in the presentation. So I'd like to introduce as well the RICS Global Commercial Property Monitor. And I believe you should have some copies of these on your desks, which you should feel free to take with you after the presentation. So this is a quarterly sentiment survey of conditions in commercial property markets. We cover more than 30 markets globally. And we also can segment these markets into the office, industrial, and retail sectors. And for many of these markets, including New Zealand, we can break them down to the city level. So we had about 2,000 respondents in the most recent quarter. And I think when we're talking about this survey, it's fairly important to differentiate between sentiment and hard data. Despite what Cameron might have said about business sentiment indexes, we like to think that this one does have some use. In particularly, we don't actually track hard transactions like you get from a lot of the agencies. Rather, it tracks changes in conditions. And doing these sorts of surveys also allow us to ask some fairly interesting questions that are tough to glean from your more transitional hard data, including things on price and rent expectations, views on the phases of the property cycle, valuations, and credit conditions. So we do this via a net balance approach. So the question, as per the example on the screen, will say something like, what have prices done in your area in the last 3 months? If 30% of respondents answer that they've increased and 40% say they have decreased, we subtract the 40 from the 30 and get a net balance reading of negative 10%, which is generally conducive to a modest decline in prices. And we're very lucky to work with the Property Council to collect responses for New Zealand. we hope to continue this relationship. If you have any more questions about the survey specifically, you can always just approach myself or my colleague Michelle Manley, as well as Rachel at PCNZ, and we should be able to answer any questions that you may have. So getting into the most recent results, the second quarter we saw a fairly mixed momentum throughout global markets. So these are our occupier and investment sentiment indexes, which is basically an amalgamation of supply and demand indicators, as well as short-term expectations for prices and rents. So basically, the closer you are to the top right of these charts, the more positive momentum in this market is. So we see that markets like Auckland and Wellington, momentum is still relatively positive there, whereas much less so in places like Christchurch. It's interesting to note that if you actually look at this data over the past several quarters, you see it start to converge towards the origin, which means that the places that were growing quite quickly over the past 12 and 18 months, growth has slowed there somewhat. And some of these places which experienced a lot of negative momentum, that has abated a little bit. There are some exceptions to this globally. Some of the later stage markets like New York and London have moved into negative territory, and we're now seeing modest declines. And some of the other markets in the early stages of an upcycle, namely Singapore, is starting to see positive momentum expand. So despite a fairly mixed outlook, the outlook for both prices and rents across global markets remains generally upbeat for the next year. So the clustering of markets in the top right-hand quadrant of this chart basically indicates that in most places, both prices and rents are expected to expand. And I think this sort of speaks somewhat to the confidence that John's mentioned in his opening. And some of the questions that we've had about some of these other business sentiment indexes. Because although not only in New Zealand but elsewhere, there's this idea that business sentiment is flagging, but we see that sentiment in the property market actually remains quite robust over the next 12 months anyway. One thing that is of note is that there are more markets that are seen to be at the peak or in the early downturns of the current cycle. So for example, Wellington over the past several quarters has been approaching a peak, and indeed a majority of people now, a majority of respondents now see the market as having peaked, whereas Auckland is seen as already starting to enter the early stages of a downturn. And meanwhile, Christchurch is still mirrored in a fairly deep downturn. And that sort of coincides with the view of valuations. Valuations globally, particularly in the past 12 months, we've seen really skewed towards being expensive. The majority of respondents in a lot of global cities now see valuations being expensive. If you separate this out via industrial, office, and retail markets, so basically if you take some of the retail markets out of this as well, this is actually increases even more. And in fact, more than 50% of respondents in both Wellington and Auckland view these markets as expensive. Something sort of notable is that although this is less so for Christchurch, the market is still not entirely viewed as being cheap. So based on current valuation levels, it doesn't appear like you're going to see a bunch of buyers swoop in. We also see a fairly mixed picture for foreign demand. Perhaps unsurprisingly, a lot of the European capitals, Berlin, Paris, Amsterdam, have seen fairly solid increases in foreign demand. A lot of this is just due to Brexit relocation inquiries. And we sort of expect this to continue until 2019 when this issue has been resolved a little bit further. Similarly, you see investors shying away from markets that are viewed as even being in the more later stages of the cycle, your New Yorks, your Londons, your Sydneys. In Auckland, we're still seeing some modest increases in foreign demand, and I think that tracks what you see in the hard data. And this has been less so in Wellington and Christchurch. Not really a surprise. Auckland's a gateway city to New Zealand. As well, international investors tend to go after larger assets, and the stock of these in both Wellington and Christchurch are much less than in Auckland. So what does this all mean? Apologies for the somewhat tough to read charts. You might have a few of them over the course of the presentation. Basically, it means that expectations are starting to moderate. Although this doesn't point to a decline per se, this does point to slightly slower growth for the remainder of the cycle, what we like to call a soft landing. So you'll see the chart on the left-hand side of the screen basically shows expected capital values on the vertical axis and actual growth in capital values on the horizontal axis. Anything above that line indicates that the market expects growth in capital values to increase from what they have previously. And similarly to the other graph next to it, which shows the same for rents. So you can see that for capital values anyway. You can see a lot of these key global markets are expected to see a slight decline in capital value growth over the next 3 months, although it broadly remains positive. The picture for rents a little more nuanced. This in part has to do with some supply and demand metrics. I mean, you try to rent some office space in Wellington, I think you're going to find it pretty difficult to do so. And if you look at forecast distributions over the past year, they haven't really changed much. So this basically shows the purple line is the current forecast distributions for the second quarter of 2018 for all asset classes, both capital values and rents. And the teal line is what they were a year ago. And you can see that they haven't changed much and they're still skewed to the upside. So people are still expecting growth, just at a slightly slower stage. And that being said, this is sort of how we see the property cycle at this current moment. So you have a place like Wellington that's sort of right around the peak of the cycle, and then Auckland that's at a more advanced stage, but still not quite to the stage at, say, a Sydney, a Tokyo, or New York and London are at. Christchurch is a market that's a little bit more difficult to place. Based on what we've seen from our own data, it appears to be maybe 4 to 6 quarters behind a market like Perth, which is just beginning the sort of nascent stages of an upswing. But it's really, it'll probably take a few more quarters to determine whether that is actually the case. There's some structural nuances in that market there. One of the more interesting metrics that we actually track is credit conditions. And this is partially interesting in recent quarters because we've seen a majority of respondents in Australia report that credit conditions have deteriorated. But this hasn't been the case for New Zealand. And the reason this is interesting, apart from bank ownership in New Zealand being largely, or banks in New Zealand being largely owned by Australian parents, the funding sources are fairly similar. So about a fifth of banks' wholesale funding in both Australia and New Zealand comes from offshore US dollar markets. US dollar markets get more expensive as the US Fed raises interest rates. And we've seen that effect starting to be passed through to borrowers in Australia, but we haven't quite seen that in New Zealand yet. So that could be a sign of things to come in the coming quarters. So now I'd like to touch on one of the bigger risks I see on the horizon, and that is China. I know Cameron sort of put this in both the glass half full and glass half empty basket. I tend to be slightly tilted towards the glass half empty. I'm one of the China bears. I should caveat this by saying that the long-term outlook for China is extremely positive. There's a lot of potential for growth in that economy. But there are several short-term imbalances that need to be addressed. And probably the one that gets talked about the most is debt, specifically corporate debt. And the problem is not so much the aggregate level of debt in China, although it is fairly large. We have seen other economies hold this much debt before. It's the rapid buildup in it, the pace that the debt's been accumulated. So this is a chart from the Bank of International Settlements, and it basically shows their credit to GDP ratio. So how fast credit is growing relative to the speed of underlying growth. So a positive reading here indicates that credit is growing at a faster pace than GDP, whereas the negative is the opposite. The red flags start to emerge around a level of 10 percentage points above GDP. We see New Zealand hit that in the 80s. As well, both New Zealand and the United States hit that around the time of the global financial crisis. And China actually hit that a little bit earlier this century in 2003 when the state was forced to step in and basically recapitalize its entire banking system. Now you see that basically since the global financial crisis, you've had a long period of deleveraging in both New Zealand, the United States, and indeed most of the developed world. However, as this has been happening, China has been increasing the amount of leverage. And I'm going to focus here on one specific segment of the market, namely the sort of risks from debt accumulated by Chinese property developers. So the one key thing to note is that Chinese residential property developers are massive. So the purple bars on this chart show the top 40 non-Chinese developers globally. So these are American, British, European, Japanese, the largest developers globally. Whereas the teal line shows the top 5 non-state-owned Chinese developers. So as far as market capitalization and enterprise value, they're in the same ballpark. Assets, I mean, the 5 top Chinese developers have about 3 times the assets, namely land, that the top 40 non-Chinese developers do. The key thing here is both the amount of assets that these developers have, but also the assets to equity ratio. So if you look at non-Chinese developers, assets and equity represents about 50% of assets, right? So that means that about 50% of your funding sources are coming from equity and 50% non-equity, so debt and various other sources of funding. So for large Chinese developers, this is about 9%, 8 to 9%, which means that 90% plus of the funding for this huge pool of assets is coming from non-equity or debt. And this is often convoluted when you actually look at developers' balance sheets. So one of the structural nuances of the Chinese system, when you actually purchase a property in the mainland, oftentimes you purchase it off a plan and you pay 100% of the price up front. The developers then receive all this money, and there's very little regulations on what they actually do with it. The government's recently passed regulations on how Chinese developers can handle debt, but this cash on their balance sheets, they actually have very little very little holding them back with what they can do with it. And there's very little that they can actually do with it because there's very few assets in China to invest in. And if you're a developer, you don't really want to put it in the bank because deposit rates are something like 1.3%. So quite oftentimes, all of this cash is then sent to buy land, right? So what we've seen over the past 5 years is extreme volatility in land markets and a huge buildup of acquisitions on the mainland. But of course, this cash that developers receive is still a debt, even though on balance sheets it's not treated as such, because in the end, in 2 or 3 years' time, you have to deliver an apartment. But rather than being listed as a debt on the balance sheet, it's put under something called contract liabilities. So that means that debt to equity ratios for Chinese developers, if you just look at the balance sheet, it actually looks pretty good. So I'll take the example of one of these 5 developers. Their listed debt equity ratio is about 86%, which is fairly healthy. When you include these contract liabilities as a form of debt, that ratio jumps to about 460%, which makes a lot of these Chinese developers actually look more like investment banks than property developers, which is a bit of a red flag considering investment banks are in the business of leverage and developers are not in the business of lending money. Now, this comes at a particularly precarious time for developers because it's coming as revenues are actually slowing and costs are rising. So the top two charts basically show you that sales prices have been slowing and in some markets declining, whereas sales volumes have been declining since about 2017. So you take slowing or declining prices side by side with declining volumes, and that means the revenues are falling. In the meantime, the chart in the bottom right shows that borrowing costs have generally risen. And the bottom left shows that construction costs generally rise after a big burst of residential sales. That hasn't happened yet, so that indicates that sort of construction costs are likely continue to start rising in the coming quarters. Now, normally developers would fill gaps in their balance sheet by looking at via the shadow banking system. But the government has announced that they are cracking down on this form of lending. This crackdown has only really just begun. These are the main types of shadow financing instruments. As of Q1 of 2018, there's still modest growth in the issuance of shadow banking assets. That's basically flattened. But if this is to persist for several quarters, if the government is to see this policy through, then Chinese developers are going to have an extremely difficult period of refinancing over the next 2 years. Now, I won't go into too much detail on this one. This is just a map of the Chinese shadow banking system. There's two things that I want you to take away from this. It's that the shadow banking system is extremely complex and interconnected. Okay? And the second is that banks are at the center of this system. So what this means is that if there's a problem in one part of the system, it can easily spread to another part, right? And it also means that an issue in the shadow banking sector can easily become a banking sector issue. And when you speak to a lot of people, especially those, as I do, who work in Singapore and Hong Kong and Shanghai, these are very smart people, people with a lot of knowledge of the market. And you ask them about this deleveraging drive, these debt risks, these refinancing risks. And the idea is that, the government will take care of it. And although I'm not saying that any sort of implosion or meltdown is by any means certain. Indeed, a lot of this is sort of mirrored in the shadow banking sector, which by its very nature is very opaque. So it's difficult to see what can be ring-fenced and what can't be. It's no matter how you actually cut this, the government's response will have consequences. So the central theory is that, the government will just come in. If there's a run of bad debt, the Chinese government will just, take its vast amount of reserves and recapitalize the banks. But all that's doing is shifting debt from the corporate sector to the government's balance sheet, right? So you're really not actually solving the problem. Okay? And it would also be particularly worrisome if China's sovereign debt levels went from 50% of GDP to 150% of GDP overnight. Given how markets have reacted to a number of other shocks, it would be difficult to see how this one would not indicate markets to go into a vastly risk-off mode. So that's all I have for my presentation. I'd just like to highlight a couple things that we have coming up. Putting on my RICS hat now. We are expanding our data coverage of Asia Pacific. We'll be covering the construction and infrastructure market. We'll be testing this in the upcoming quarter. We hope to continue working closely with the Property Council to do so. I'd also like to take a moment to thank anyone in the room who might have responded to any of our surveys. And for those of you who may not have seen them or would like to respond, I definitely encourage you to do so. And with that, if there's any questions, please.
Sean, thank you very much. I mean, you got up and started your presentation by saying you were going to take a slightly alternate view to Cameron. And it sort of reminded me of the saying that if you ask two economists the same question, you'll get three different answers. But I do have a question for you. You almost answered what I wanted to ask around sovereign debt exposure, but how does that apply to the shadow banking market in China?
So I don't know if sovereign debt exposure necessarily applies to that market.
No, I meant more here in New Zealand. If Chinese have got a high sovereign debt exposure, does the shadow banking sector also have a similar exposure?
To some extent, yes, but it would be more via second order effects. Because the companies that would be exposed via other debt exposure would also have a lot of shadow banking liabilities. Shadow banking liabilities tend to be very short term, so you're looking at a 12 to 18 month sort of issuance period. So these need to be refinanced fairly frequently. But yeah, via that sort of second order effects, you would still have some exposure.
So you raised a lot of questions. Well, you raised the issues around the Chinese market. How does the New Zealand property market respond?
Well, I think the only thing you really can do, because New Zealand, I'm Canadian, we have a very similar economic structure to you, where we're vulnerable to a lot of exogenous shocks, and this would naturally be an exogenous shock. The best thing you can do is just to make sure that you're sort of fully aware of the risk and to have hedged appropriately, and that's really all you can do. It's like everything, just don't be overexposed.
Ladies and gentlemen, Sean Ellison, thank you very much. We have a small gift